Perfect. David, morning. Nice to see you.
And you, mate. This is it's been a long time coming, really, hasn't it?
I mean, I want to say probably pre-COVID, really. And then the last time we wanted to do this, a storm got in the way.
Yeah.
And now it feels like a real storm's coming as well. Before we get into that, it's probably worth you just introducing yourself.
Yeah, absolutely. Right. My name's David Belle. I'm the growth director at TradingView. Been a trader for a fairly long time, personal account. Was a broker in the mid-market and also in retail as well. And I run Macrodesiac, which is kind of a research firm, I guess, that provides a guide in hand to retail traders. Because what you tend to find is that all of the macro commentary that's out there is just not digestible for retail guys. So we like to describe it as you're sitting in the pub with your mates after a couple of pints, where you keep high level topics. You're kind of just sober enough to be able to explain high level topics in a simple way, because if it was to be complex and you're a little bit tipsy, you wouldn't be able to explain it. That's the best kind of overview that I can give for Macrodesiac.
I think that's a really sound analogy. I mean, I've read your writings and listened to what you've said for years, and yeah, absolutely. I mean, you do cut through an awful lot and get to the point. We've got a myriad of subjects that we could cover today with everything else that's going on. We're filming this 8 days into Russia's war in Ukraine.
It seems like a month.
It does, doesn't it?
God.
And doesn't it also feel like everything that we've come through since is just a distant memory? I mean, had this not been around, we'd have been 2 weeks into, post-COVID full freedoms, and that just feels like it's months ago now.
Yeah.
What are we seeing in the markets as we stand at the moment?
Well, European equities are absolutely battered. It's something that I note quite a lot recently. A lot of people tend to be looking at the US equities, which is fine. Largest equities in the world in terms of the indexes. But there seems to be less of a focus on things like the DAX, the CAC, the FTSE even. And I think it is kind of a bias over the last kind of, 2 years of pure bull market stuff related to US equities. But now we're really, really seeing the DAX, for example, come off heavily. And I think it's got a lot to do with, obviously, the proximity to the geopolitical conflict, whereas the US is much more insulated to it. It's less involved. There's less connection between the US and Russian natural gas, maybe even, I guess, Russian wheat, grains, Ukrainian grains or wheat, for example. And people tend to be ignoring that. But the DAX is trading now currently, I think, about 13,300.
And where was it prior to this or at the start of the year?
15.6K.
Wow, okay.
Yeah, and the ES is down at, I think, 4,350, say, maybe just between 4,350, 43.25. So there's a big disparity there, especially in the way that it's traded. The ES is kind of going a little bit rangy almost. And all the focus tends to still be on the US equities, but all of the opportunity so far has been in Europe. And I think it's shown a really, really kind of big thing there, in that, Europe really, really is being heavily affected by this, and the market is showing it. I'm saying that the DAX is in crash mode. We saw a 5 sigma move in rates. We saw a 4 sigma move in rates last week in Bund. Yeah. I think it was a bit of a squeeze, but it's kind of beyond the point. There was a long duration, high quality liquid asset kind of search there at a time of stress. And we're also seeing large moves in the general rates environment as well. The MOVE index moved 5 sigma just yesterday or the day before.
Wow.
So, we're seeing really, really big moves that are indicating, underlying signs of stress. FRA OIS spread was up 4 bips just yesterday, which is showing some interbank stresses as well. And, if we continue that same pace up until the hike, it should be at something like, 45 basis points, which is really, really showing interbank stress as well.
I read, as I was coming in today, there was a Deutsche Bank analyst, pretty senior in the bank, saying this is the point that the ECB need to start intervening in the FX market. Would you ever see that? Can you ever see that?
Well, considering Deutsche Bank's probably the largest FX dealer in the world outside of Citi,
they've probably got talking his own book.
Yeah, exactly. There we go. Do you know what? When you look at the recent FX interventions, let's take the Swiss National Bank with what they've been doing. Buying US equities and offering the franc. It's not worked. even, you know, the Russian central bank, okay, it's a little bit of a different context. They intervened just last week. It moved up for maybe, I don't know, 15 ticks and got absolutely slammed again. Yeah. But you continually see that. The BOJ as well, they've intervened a couple of points. It's just not worked. Yeah. So I don't know if the FX interventions, especially with, you know, FX volatility so low, actually can do much. You know, you'll get a little spike, but then it just gets flattened again.
No, I think there's so much cash in the system as well that, you know, you haven't got limitless firepower. It's not the Mario Draghi moment of probably 10 years ago now, where you can say it. You know, you've got a balance sheet that's probably 5 times the size that it was. You haven't got the power to do it. They were also actually saying in the article that it might be time for verbal intervention. Could you see that working in the world that we've got? Can you go back to a Mario Draghi, we'll do whatever it takes?
I don't think so. And do you know why? Christine Lagarde, back on March 23rd, 2020, I think. Remember when she said, we're not here to close spreads? Yeah. Spreads ballooned straight up. And eventually they did, but it wasn't due to her. So, you know, the focus, I think, on markets at the moment is purely based on the tightening regime. Mm-hmm. You know, it's still very, very sensitive to, say, what Bullard said. I think it was just yesterday, even what Powell said. And what Powell said yesterday in answer to one question, it was in relation to Volcker. Okay, and I think a reporter called Shelby, she'd ask, or he'd asked, I don't know, I just saw the text. She'd asked, would you go as far as Volcker did, and I'm paraphrasing here, in terms of bringing about a recession to contain inflation? And Powell's answer was, if you look at history, then the answer would be yes. So he did, punchy. Wow. Really, really punchy. And I don't think the market digested this. And there was also talk of bringing the rules back. So Taylor rule, balanced approach rule, adjusted Taylor rule. Now, if you focus on bringing the rules back, that would indicate interest rates at 4%. And the market hasn't digested that either, I don't think.
The market can withstand an awful lot, right? Because the market doesn't implode or explode, it just gets upset. Yeah. But can the consumer handle 4%?
Absolutely not. It would never go to 4%. But it's just showing how aggressive they possibly have to be. You know, the 2s10 spread is currently at about 29, 30 basis points. That's flattening massively. You know, if we get to 0, that's recessionary. Every single time it's gone inverted, a recession's happened. So I think they really need to get ahead of this quite aggressively. And, you know, the market has been underpricing because of this war, the fact that 50 basis points could occur.
Mm-hmm. Yeah. And they've almost discounted it entirely looking at the forecasts.
And I think 50 basis points is right on the cards purely because they want to get away from that 0 lower bound. Mm-hmm. So they've got ammo for, you know, later on. Imagine if the US goes to negative rates.
Yeah. Yeah, the world's upended, as we know.
It's on par with the ECB, BOJ, you know, SMB, Riksbank. It would just be totally bizarre, and it would be a total misallocation of capital. Not that that's, you know, not already happened. Yeah. But, you know, following that in the years after, considering how long it takes for monetary policy to kind of make its way to the real economy, about 20, 25 months, you know, that's a really, really big issue. So I think the aggression that they need to actually go through needs to be factored in a little bit more. And there'll be pain in risk assets if that does happen.
Sure. And I think we're already seeing, probably since the back end of last year, markets adjusting away from equities being the only game in town, mm-hmm. You know, from a sort of a longer term, more sort of retail portfolio investor. What's your take on, and let's go to US equities that are having a, you know, less torrid time of it. But what's your take as rates do start to creep in? Is there still value left at current levels, or do equities need to correct massively?
See, this is the big problem. If you look at the Russell back in January 2021, it had a price to earnings ratio of 0 because there were more firms in the index that weren't making any money or losing money than there were profitable firms. So how are they necessarily coming back from that when all of the fiscal support's being withdrawn? Mm-hmm. When it seems like we're going to monetary tightening, and also we've got all this crap basically occurring, you know, it doesn't necessarily make sense. And the one canary in the coal mine for me that hasn't really moved just yet is credit spreads. And I think they're due a blowout. They're currently trading the highest since March 2021, albeit really, really low. But when that happens, you know, one of my mates works at a credit research house, and I was chatting to him just last week. I think it was on like maybe last week before, on I think the 23rd or 24th of Feb, and he said that there hadn't been a deal done, a high yield deal done since the 10th of Feb. So that was about 2 weeks. Now that's unheard of. And on that day, he'd actually had 3 reports of deals being cancelled because of the market conditions. Now, if you consider that firms don't want to do credit deals, that sounds like a bit of a liquidity issue, right? And so, you know, I really see credit spreads as being the one factor that hasn't necessarily moved enough yet.
Right.
US specific here. Europe, they've blown out a tiny bit more.
Yeah.
And that's probably reflected in things like the DAX move and whatnot. But yeah, US credit spreads, I'd really be paying attention to.
Particularly if they go on a 50 basis point hike.
Exactly.
Yeah, that's
exactly
significant.
And also over the coronavirus pandemic, because, you know, meetings and negotiations couldn't be face to face for a lot of it. Firms were already pricing debt at a premium to get the deals done. So if you consider that these are firms that are already under the cosh, you know, they're paying above odds due to some kind of idiosyncratic factor.
Yeah.
So, you know, big issues there, I think, in credit.
Wow. Okay. And I guess that comes down to refinancing cycles and things like that. That this adjustment probably is overdue, but still might take a while to materialize.
Yeah, that's kind of what I'm thinking. I think people are still very much used to the lax monetary policy of the Fed, and you know there's always the kind of thing, buy the rumor, sell the fact. But I don't even think people have bought the rumor yet. Right. You know, in terms of the repricing of interest rates.
This is probably a slightly removed, well, it's across the pond from where we're talking about. But in the UK, you know, when COVID hit and we were talking about, you know, being barraged with defaults and liquidations and companies falling into administration, and that hasn't significantly happened yet. Do you think we've ridden the storm, or is it again something that's a ticking time bomb and is going to materialise at some point in the future when credit conditions change?
Well, do you know what? When was the last time you went into a shopping centre, or not a Westfield or?
I went to Tunbridge Wells 3 weeks ago and it depressed the hell out of me.
There we go.
Yeah, it was horrific.
That's literally what I thought as well. I went down to Centre Court in Wimbledon and Kingston. What's the one in Kingston? I can't remember.
Bentall Centre.
Bentall's, that's the one.
There's knowledge.
And same thing, you know, empty shops, all of this. So, you know, I think that might have some kind of, what's the word? Relationship as well to commercial property and what that's signifying for businesses. You know, how stretched are business margins that they just have either, you know, shut up shop and can't come back necessarily. Yeah. And what happens then? You know, I think that's sometimes you have to kind of step away from the data and just look at what's going on around you. You know, if all of these brick and mortar shops are shutting down, what does that mean? It clearly means that money's not going into them, or things are too expensive for them. You know, Amazon obviously is a different beast. People have moved online because of the pandemic, but still, those pandemic effects of moving online are going to have an impact on firms for years. Yeah. You know,
and they're still relatively supported now, or coming to the end of the support that they've had.
Yeah.
Over that, and if habits don't change back, and it's probably unlikely that they fully will restore, and we've got an increase in the cost of living, and in theory consumption goes down. Though, you know, I was at a restaurant with a client on Wednesday night this week, and it was packed on a Wednesday. So consumer habits haven't changed quite yet on what's potentially around the corner. Yeah. But if people do start to tighten the purse strings, it's only going to get harder for those entities, isn't it?
Well, I think there's going to have to be forced tightening the purse strings if you just consider energy. You know, most inelastic product that's out there, I guess, apart from land housing. You know, people have to heat their homes, have to drive their cars to go to work. But it's almost like a bottomless pit at this stage, because you're going to work or driving your car to work, but you know, that money to drive your car is going into paying for your petrol. Yeah. You know, so people are going to have to tighten their purse strings. And, you know, I've spoken about demand destruction quite a lot. This is clearly it. I saw a report that Turkey has only, I don't really know the measure of how many, it might have been like something like 285 tons, but that probably doesn't sound right. But in terms of the amount of wheat that they bought, Usually they buy 350 tons or whatever the measure is. They only bought 285 tons because the price of bread in Turkey is so high. And obviously we've seen the wheat price increase to all-time highs just an hour ago.
Going to continue to do so.
So, you know, these factors are contributing to demand destruction. And of course, you know, it alludes back to those shops being shut.
Yeah. So put yourself in the position of a central banker, not the Fed. What do you do? So if you're sitting in the Bank of England, how do you sort of look at this and go, okay, I can kind of see what's coming. I can see a cost of living crunch. I can see consumption or demand destruction just coming. What do you do?
That's a very difficult question. You know, I think central bankers, especially in a market like the UK, where the FTSE has gone pretty much nowhere, it's a different context because obviously in the US they're focused on risk assets, the wealth effect coming from equities being so high, pensions, that kind of thing. I think personally in the UK, because we're not used to those markets going so high, they need to hike rates higher. Yes, have some pain in the short term, absolutely, but I think that would come anyway. I think what's happened at the end of 2019, if you look at most data, and also, you know, the 2s-10s curve that I was talking about previously, that actually inverted in, I think it was August or September of 2019.
Yeah, I remember.
Which is always a recession indicator, right? And we were seeing data tick down then as well. And I think what the coronavirus response, both monetarily and fiscally, has allowed the economy to do is kind of avoid that business cycle, you know, the end of that business cycle. I think we were heading for a recession anyway at the end of 2019. And now we're kind of getting a double recession because we've kind of, I like to call it the faux business cycle, because we've just allowed things to continue. Changed behavior, absolutely. But you can even look at how that changed behavior from what the government have done, or governments globally have done. You know, the increase in shipping rates, for example, the fact that ships had to turn around with empty containers in the US, at Los Angeles, at Rhode Island ports, just to get back to China because there wasn't enough demand going US-China way. You know, the fact that all of these, you know, small businesses have shut when they might not necessarily have done, you know, all of that support, although it had to happen because of lockdowns, that has contributed to a massive misallocation of capital and a massive misallocation of behaviors as well, kind of, if that makes sense.
Yeah. Absolutely. I mean, we've probably been storing something up for longer, but it becomes greater as a result of it.
Massive pressure cooker.
And what's the timeline on a recession look like in terms of getting into it and then getting out of it?
Well, I think this is one of the problems, is that we're in such a different kind of reason for being in recession this time. I think it's due to inflated data everywhere, not just in equities, but in, you know, base effects of GDP growth, in corporate earnings. You know, no matter what happens to corporate earnings this year, I mean, they're not going to be able to beat. So if they come in line, it's a negative.
Yep.
If they miss, it's a negative. And it's most likely that this is going to happen. So you can't see any fundamental drivers for an increase in growth coming. And it's just a bit crap, to be honest.
Yeah.
The only answer that there'll be is to lower rates from central bankers, obviously, to try and get some demand going. But at the same time, they're at so close to the zero lower bound that it doesn't really give them much wiggle room.
No, and they've already spent so much on quantitative measures as well that you can't really do much more with that.
No, exactly.
It's funny, I remember that probably the last time we had a chat, which it feels like forever ago, we were talking about the risk that central bankers start monetizing the QE that they've done and what that would do to inflation. And I think we were both sort of the view that where is inflation, given all the money that was being printed at the time? And now it feels like it's come back to bite on so many levels. Do you see it? Do you see inflation being, let's call it medium term, because short term is gone now. But is there a medium term transitory element to inflation?
Look, I've always been in the transitory camp, and kind of until the last couple of weeks, until this war kicked off, to be honest, because you can't stay in the transitory camp necessarily if you've got Wheat and grain prices up here contribute so much to the food cycle, and pretty much everything. You've got nat gas contributing to fertilizer production, heating, energy, oil up at whatever it is now, $120, something like that. Ridiculous. So I think it will go on longer than kind of I predicted. Perhaps the only thing that could alleviate it now is really that demand going.
Yeah.
That is really the only thing. You get that demand destruction where people don't want it more. They're going to have to charge less for it, unless there's still a supply throttle somewhere. And I think, energy is the big one. I mean, just to be clear on what I mean by transitory, because I don't think anyone's actually given kind of an objective descriptor of what transitory means. And I read a paper, and I think I mentioned this, the monetary policy mechanism duration. Briefly mentioned it at the start. And basically it indicates that in developed economies, it takes about 20 to sometimes 50 months for monetary policy to actually come into the economy completely. So the way that I've kind of modeled it in my head is, if inflation were to come down before that monetary policy mechanism, so minimum, say 20 months, shows that inflation is coming down, then it's transitory. If it comes down after that, then it shows that a policy response was required and that it's not transitory. So I guess the timeline that I'm working on is 20 months in my head.
Sure.
And maybe economically that's not right, because people couldn't sustain 20 months of really high inflation or increasing inflation.
Yeah. Well, I think on increasing inflation, we're probably already 12 months into that 20-month horizon, aren't we?
But we haven't had a policy response.
Right. Okay.
Necessarily. Well, in the UK we have.
Bit of normalisation.
Yeah.
Nothing too aggressive on that. Okay. I want to move it away. I'm conscious that we could sit in it and talk for hours, but crypto. Mm-hmm. I know it's something that you've got some opinions on, and I just wanted to see what your thoughts are. Obviously, last year we saw the big sort of retail, the free money that was being written just about everywhere over the world, just piling in to meme stocks and to crypto. And since then, it's been a rockier ride. Mm-hmm. What's your take on crypto as an asset class, but also if we look at it over the next 2, 3, 5 years, perhaps, how different is it going to look? And maybe if you can, what's it going to look like?
In a simple sentence, crypto to me is a short volatility trade. You can either be short the VIX or long Bitcoin at the end of the day. Yeah. That's the way that I see it. And it depends on which one's cheaper and which one maybe you can construct a better trade out of, but it's probably simpler just to be long Bitcoin, hold spot. Over the next 5 years, I see it very much being the same as it's always been. It will be productive in going up when rates are low, when policy's easy, and it'll be, am I allowed to swear?
Not really.
No, okay. it'll be rubbish when rates are going up, basically. Right. That's just the way that it is. I think recently we've seen Bitcoin perhaps find a safe haven bid off of money being transferred out of certain places. Mm-hmm. Perhaps, I'm not 100% sure, but it has decoupled from equities a little bit in terms of the correlation. But the way that I see it, DeFi is very similar to the ICOs that everyone now hates. Mm-hmm. NFTs, I think, Emperor's new clothes in a bit. It's kind of like you see these pixelated images, and it's like, how is that going for however much one of them went? 68 million, something like that. And it's like, oh, come on. I get that there's a lack of supply of some of them, but they just look a bit crap.
The person that paid 68 million for that must have made the money just from being early into crypto, and therefore is just recycling maybe free money into more. I would hope anyway. Maybe
one of the things with NFTs is that I'm only a fan of very, very specific art. I can't really appreciate all types of art. If a
16-bit digital monkey doesn't float your boat.
Well, exactly. Yeah. There is the kind of whole provenance of it, like where it's come from, who maybe made it, how it was made. But I don't care if I don't think it looks good. I can't value something like that.
I take a slightly different view on it. I mean, I agree with what you're saying on the art. I think this is the baby steps into NFTs finding its place, or not even thinking about it as an NFT, but thinking of it as a smart contract.
Yeah, no, I agree with that.
And finding its feet there it's annoying that these things all have an underlying digital currency. I understand the reason, or were bought and sold with crypto, because that feels like a smart contract's a really good idea, but having something as volatile as a crypto to buy and sell it with almost stops it becoming commercially or broadly accepted.
Yeah, well, right. It's funny, this is one of the things that I kind of get into with crypto guys, especially when they're talking about reserve currencies, because you couldn't have a reserve currency. Could you imagine if the dollar was as volatile as Bitcoin?
Yeah, the world wouldn't function.
Exactly. Yeah. So it's either, an asset that you want to keep going up, that you can make money and buy dollars with afterwards, or you want it as a store of value and have some ideological view on it. Which one do you want? Yeah. Because I doubt many people would want Bitcoin if it's not going up.
True.
Do you see what I mean?
Yeah, particularly, I've never bought anything with...
No. Now, some people do, absolutely.
Right.
But isn't it just as easy to use your card, type in your details? I've actually made mistakes with, transferring crypto and the hash and stuff like that.
Sounds expensive.
Yeah, to be fair, Binance are quite good with it and they gave me it back. But at the end of the day, it was merely transferring from one wallet to another to try and get, pounds out of it.
Yeah, but no, it's an interesting point, isn't it? I mean, Bitcoin feels like it did start, or is, very ideologically driven, but perhaps less and less so as things go on and people want more utility from it. But with utility comes invariably regulation, which erodes the ideology.
Do you know what? This is actually a conversation that I had. So in terms of ideology, Bitcoin started out with quite romantic narratives. It had the founder, Satoshi Nakamoto, who's probably, what's that bloke's name? Hal Finney, I think, is probably Satoshi. It had that. It had the idea of an inflation hedge. That went away. It had the idea of being decoupled from risk assets. That went away. It's kind of lost the idea of being a reserve currency because of what we've just spoken about. So what does it have left? It has the fact that, it's outside of enforcement. However, Canada has just proved that it might not be. So what is there left? And now this isn't me being anti-crypto. It's me taking, an objective view to see what it actually is. And that's how I come to the conclusion of it being a short volatility trade. Being long Bitcoin is purely that.
Yeah.
The same way as if you were long the Nasdaq, that's a short volatility trade. There was a meme for years about short the VIX because it was just a money printer because of low rates. So it's like, take an objective view on it if you're a trader and see kind of what it really is,
So sort of circling back to the question, do you think for the next few years, as we see it, there's going to be no quantum leap in what the utility of these things are, and it is just going to be people just trading it in and out, perhaps with less regard for it as interest rates rise in the real world?
I think, the Pareto principle applies to everything. So there's always going to be that, maybe 10 to 20% of cryptos that actually have a specific use and can be enjoyed. But the amount of... So I'll give you an example. At TradingView, in my last kind of role at TradingView, I was, taking the requests from a lot of DeFi people to use our charts, on their websites and stuff like that. And I'd receive the request, reply 3 days later, and the email address would be gone because that project had blown up, gone away. So that's the kind of 80% of rubbish that I'm referring to. And what we saw from the ICO mania was that a lot of the firms that are still going now are strong. So it's kind of like separating the wheat from the chaff. It's like creative destruction every bear cycle. So in a way that's a good thing, but I guess there's a lot of people that lose money on the way down as well. So it is good to see that. It's just a shame that there aren't really as many barriers to entry so that, we get more productive crypto uses and utility.
I feel like, I agree on that. I think that crypto is taking longer to almost rebalance and for the wheat and the chaff to be separated because there's so much retail money in it. The dot-com bubble, 20 years ago was institutional money largely because it wasn't easy to get in and out as a regular punter on the street, whereas anyone can jump into a crypto. It feels like it's that money that's taking time to get through the system. I agree. I just think it's going to take longer to manifest. Maybe 1 or 2 cycles before we actually find out what it is.
Well, the interesting thing now is probably CBDCs that are coming into play.
Go on.
Central bank digital currencies.
Yeah.
You know, Andy Haldan in 2015, and this was in a response to how low we can go in terms of interest rates. He said one way to make the zero lower bound of 0% interest rates sort of more effective, I guess, is to charge a negative rate on a digital currency that is state issued, basically. Now that's quite scary. It's quite dystopian. But this is what he said. It's either the Porter Down speech. If you Google how low we can go, Andy Haldan online, then you'll find it. And it's on the bottom of the first page, and it's the third point that he makes, and it's really, really interesting. Seeing that in 2015 they were even talking about this. Switzerland as well is one of the in I think it's the Zug region, the canton of Zug. They're one of the most forward-thinking crypto places in the world, basically. And the Swiss National Bank are probably thinking the same thing as well. They're probably thinking of doing that because they're not moving away from their policy of buying US equities and doing whatever with. However, they've still got negative rates, so they're going to want to find a way to keep that inflation higher. Now, obviously, they've just printed a relatively high CPI print. I think it was overnight on Wednesday, maybe. Overnight Wednesday, Thursday morning.
What was the number?
I can't remember. It was over 2%. Though.
Right. Okay.
So that's big for
absolutely.
big for Switzerland. So yeah, I think there is a movement towards CBDCs, and even Powell has had some mention of it just yesterday as well. I can't remember the specific quotes, but he was mentioning CBDCs too, and he was saying that they're different to the likes of Bitcoin. So they are looking at these things, and I think after every single cycle that we have when there's a recession, because quite frankly we are going to a recession, all signs point there, is that you do get this creative destruction, that new ideas come to the forefront, old crappier ideas go away, because it's almost like forced. You have to find another alternative to things, right? And I think that is one way that central banks are looking to be able to be maybe more efficient in their heads with how their policy gets through to the real economy. Obviously, the everyday person's going to dislike it, though.
Yeah, but the central bank holds the cards, right? You couldn't move an entire population to Bitcoin because you'd lose the tax base, and who's going to allow that to happen? Well,
exactly.
So if the argument is this makes us more efficient, but also I'm just thinking whilst you were speaking that CBDCs would allow the Web3 applications to work. You could exist on the blockchain without having to go through a particularly volatile cryptocurrency to get there, which kind of joins the dots on my thinking that there's potentially loads of applications for the mainstream if only you didn't have to suffer Ethereum on the way into it, and not knowing whether in real terms your cup of coffee in the morning was going to cost you £2 or 20 quid, depending on where the market's gone the night before. But again, we could speak for hours on this, and I'm glad we got a chance to catch up. We'll wind it up now for this one, just whilst the cameras are rolling, and then probably crack on. But but thanks for coming down. It's really good to see you face to face.
No worries, mate. Anytime. Cheers.